Welcome to another edition of the Endeavour Exchange. I'm excited. I get to do the intros for once. Brent's normally the one leading things off, but I'm excited about this one. Today we're talking about everything affecting your money, as we always do. And Brent, been a lot of talk about bubbles coming up. I mean, this has been like a hot topic for the last 15 years, but
feels like that anyway.
But a lot of talk about bubbles. Market's a little frothy. I know there's been some recent, headliners basically talking about this. So anyway, is there a stock market bubble? That's the question.
Good question. Well, it's interesting. Ray Dalio just came out with a recent report looking at just this question. And for anyone who is unaware, Ray Dalio, when it comes to investment professionals out there, at least well-known investment professionals, I don't know if there's anyone out there that studied the economic cycle and bubbles as extensively as Ray Dalio.
He's the man.
So when Ray's talking bubbles, I think it's definitely worth listening to. And Ray Dalio and his firm Bridgewater Associates have what they've put together. It's called a bubble indicator, and they look at kind of 6 core areas to determine whether or not they think there's a bubble. And I'll kind of walk through all 6 of them here. So the first one is how high are prices relative to traditional measures, and what they found. And actually, we have a chart here that we can put up. In the how high are prices relative to traditional measures, we're in the 82nd percentile right now. Are prices discounting unsustainable conditions? With that one, we're in about the 77th percentile from the data that they have going back. Number 3 is how many new buyers are in the market. So those who weren't previously in the market, how many of them have entered the new market? And for this one, we're looking at the 95th percentile. So a lot of new buyers out there. Number 4, how broadly bullish is the sentiment? So the more bullish the sentiment, the more people already have invested, so less likely that they're to invest anymore. If things start getting really bullish, there's not a lot more that people can invest if they don't have the cash to do that. So in that one, we're looking at the 85th percentile. The 5th is our purchases being financed with high leverage. We've heard with regards to the GameStop and a lot of what went on there. What's concerning is when there's leverage purchases, the underpinnings of the buying are weaker, and it's a lot more vulnerable to forced sell-offs. So it can cause some really sharp sell-offs when we start seeing excessive amounts of leverage. And with that, we're in the 80th percentile. And the last one is, have buyers made exceptionally extended forward purchases? So have companies started building inventory or locking in future contracts at certain prices, either to speculate or to essentially protect themselves from rising prices.
Right.
So if we look at all those and we look at the chart that we have, Ray Dalio's kind of looked at the market for one as a whole, and he's compared it here to the 1920s, the dot-com bubble. So in the 20s and the dot-com bubble, you can see across the board, except for one of those gauges, bubble all the way through in those times. 2007, so leading into the financial crisis, we have a couple that were actually not pointing to a bubble at all, some frothiness in the market, and then a couple of those pointing towards a bubble. Today, we're seeing, some somewhat frothy, a little bit of bubble, no bubble at all when it comes to the market as a whole. So the market as a whole, Ray's saying he's not necessarily seeing signs of a bubble, but then he segregates it out to what he calls emerging tech. And emerging tech, prices are relative high to traditional measures, frothy. Prices are discounting unsustainable conditions, frothy there. New buyers have entered the market, bubble. Is there broad bullish sentiment? Bubble.
Yeah.
Purchases being financed, bubble. And then the last one there, the extended forward purchases that businesses are making, somewhat frothy. So it's actually quite interesting because there's a little bit of a divergence there. So is there a bubble? I guess you could say, yes, there is, but where is it?
Yeah, I think that's super interesting because it's like highlighting what we've been saying for a long time, which is you have to be choosy. And if you're just buying the broader market as a whole, you might be getting into trouble with that. But if you're choosy and avoiding certain overvaluations, if you will, then you can still do quite well, obviously, and there are opportunities out there. And I don't think he's saying that it's going to come to an abrupt end right away either. He doesn't know that. And nobody does.
Actually, in the report, he goes on to say that. So we start talking about bubbles. The question then becomes, what do you do, right? And Ray goes on to state that his indicator is not meant to be a timing tool. It's really not. However, he does feel it's a good predictor of what he said relative performance for the next 3 to 5 years. So, I mean, what do? The first is possibly lower your expectations in certain areas if prices are pushing that much higher into territory that would be considered overvalued.
Sure.
Well, you're probably looking at some lower returns in the next little while. He's also saying, a favoring of non-bubble stocks. So, but again, it's not a timing tool, and the biggest, brightest, and best investors in the world are still invested. As you mentioned, it's time to be very choosy about what you're getting involved in, and if you're getting caught in some of these areas where he is saying indicators are flashing bubble, well, you may be exposing yourself to a lot more risk than you realize. And it's some of those areas, obviously, that we've seen do really, really well through the pandemic, that people are talking a lot about.
They did well. Everybody knows they did well already. So, yeah.
So to answer your question, is there a bubble? Well, Ray thinks it's in pockets. But, I think now moving forward, it's about being picky, being choosy, and as well just having some defense. Howard Marks is notorious for talking about defense and offense, and you're never all one or the other, and that there's this finding the right amount of in between. So we're still invested, but we're being cautious.
Right on.
Grant, we've seen recently it's not all the clients, or it's definitely not all the clients. It's a small minority of clients, but in certain situations, what we've seen recently is a planning strategy called a reverse mortgage, and it's something that I'm sure people have, or not everyone, but people have heard of, and they're like, well, what is a reverse mortgage? So I figured I'd pose the question to you.
Yeah, I mean, it's certainly not an everyday kind of a strategy, but it can be an effective strategy or an effective solution, because a lot of people are sitting on, houses that they've owned for a long time, and they've got all this equity built up in these real estate properties, houses, condos, whatever it is, and in many cases that just becomes like dead assets to a lot of people. Mm-hmm. I've always been a fan. I mean, not for everybody, but for myself, using equity to borrow, to invest, because I feel like I can do better, using that equity and using it to buy into like market securities, things like that, like stocks, companies, whatever, and can generate a lot of returns by doing that. But again, that's not for everybody either. The reverse mortgage, though, it's exactly as the name suggests. Like, when you have a regular mortgage, you've bought a house or you bought a property, and you're paying the bank back for the mortgage that you've borrowed. The reverse mortgage is the exact opposite. You've got the property already, you've got the asset, and so they're going to give you a whack of money up to 50. I think it's 55%, if I remember correctly. They won't lend up to the whole value, but they'll go up to 55% on the mortgage, on the reverse mortgage. So you can take that out. You can do whatever you want with it. That's money that you can use to live on. You could use it to invest if you wanted to. You can go on vacation, whatever you want. I mean, there's some do's and don'ts in there, but you can use that money for whatever you want. Now, the kicker is there is a cost associated to these programs. There's appraisal fees. There's legal fees. There's certainly an interest cost associated to it, and the interest costs are typically higher than what a regular mortgage would be, so you're paying the bank back at a higher rate than what they borrowed it out to you originally for, typically anyway. So legal fees, setup fees is another one, and depending on the lender is ultimately going to determine what those fees all are, but there are definitely fees. There's early payback penalty fees. If you thought, I'm going to borrow it out now, but I'm going to repay it in a couple of years kind of thing. There's early payback fees for that. So when going into these, I wouldn't go into it lightly if you're going the reverse mortgage route, because there are a lot of tricks and there are a lot of things that you need to be aware of, such as the fees, but also, what's the ultimate plan? Typically when people are living in their houses for the rest of their lives, the idea is that it forms a part of their estate, the inheritance to their family, and so by doing a reverse mortgage, you're reducing that ultimate estate value because you're borrowing against it, and that has to be paid back. So the day that you pass away, that reverse mortgage is going to get paid off as the house or the condo or whatever it is sold and paid off. So not the day you pass away, but your estate's going to sell the property and repay that in time, essentially. So there's a lot of ramifications of it, but it can be a very effective tool for people who either require assets.
Are we seeing it more because a lot of people for many, many years have viewed the home as essentially an investment. Oh, I got to pay off my home, I got to pay down that debt, and now they're sitting on this whole whack of equity. They don't necessarily want to leave their home. They're not ready to leave their home, but in order to access the equity to that they again treated like an investment account. They have to do something to get that money into their hands.
Yeah, absolutely. So in some cases, you get a situation where if they're not going to downsize their property or they're not going to move somewhere else, then this is a way of staying in your house for a longer period of time, but still using the equity that you've built up into it. I mean, it's a pretty rare solution. Like, truthfully, we've only, I think we've looked at one in the last 5 years, and that's not even a necessary solution. What I'd often recommend for more people is to look at a home equity line of credit versus a reverse mortgage, because you can borrow out against the property, the equity in the property still, but you have a lot more latitude as to the payback cycle of it, how much you borrow out. It's often quite a bit cheaper than
able to invest it and then draw from the investment.
Yeah.
Probably the interest deductibility on.
Yeah, I mean, that's actually the same, but it still gives you a lot more flexibility with it, frankly, and like paybacks, you could pay back anytime you wanted to. So I'm more interested in talking about home equity lines, truthfully, but reverse mortgages are certainly a solution out there. I think the reason why we're seeing more of them out there, like we see the commercials on TV all the time for the chip mortgage, people are living longer. People are living well into their 90s now, and I don't think that financial planning in most cases has caught up to the length of their
life
lives.
Expectancy.
Yeah, and which is something that we are actively doing here. Like, we take our plans out to age 99 for our clients now.
Which I know sometimes people are like, whoa, and we're like,
got clients in their mid-90s right
this
now.
Is conservative. We don't want to be running out of money.
Yeah, I always joke that I don't want to tell you to go back to work at age 95. That's an awkward conversation for me to have. This is probably why chip mortgages have become so much more popular. But I mean, truthfully, I think if we're doing the planning early enough, you probably don't ever need to go through that. But it is still an effective tool if you want to live in your house longer than you expected. Totally a worthwhile tool to evaluate.
Absolutely, great.
Okay, so we were talking about stock market bubble. We've talked a lot about interest rates, and I think the question is, and I've talked a lot about this with clients, is the potential for interest rates to rise. Especially if we get things like inflation kicking in. What's the Bank of Canada going to do? They're going to increase interest rates. So the question is, will interest rates cause the markets to fall? We've been on a nice run.
Yeah. Well, and if we go back, like obviously we remember it. We work in this world, but back in 2018, from September to kind of it was Christmas Eve, I believe. Rates were on the rise. Things seemed to be rolling with the economy and the U.S. economy. Rates were rising. And then, through that period, the S&P 500 was down nearly 20%. And I remember that Christmas Eve day having that really bad day in the markets because of this rate change. So it was almost bear market territory. It wasn't 20%. At the time, you could have bought Apple at 13 times earnings. Today, it's like above 30. So if you were an equity investor, it did present some interesting opportunities. But as I mentioned, the culprit of the sell-off was the Fed raising rates, which spooked many investors that the party in the punch bowl was getting taken away.
Yeah.
That was low interest rates, cheap money. Today, we're seeing headlines again, which are bringing many investors back to those 2018 memories. But there's actually an important distinction. In 2018, we saw the Fed rising the short-term rates, while long-term rates remained steady. This ultimately flattened the yield curve, and we were looking at an inversion in it. And so typically, that's a lot of investors have used that as a tool
It's become a hot button, yeah. Even to the amateur investor
here
out
it comes,
there, yeah,
right?
Yeah, totally.
The yield curve inversion.
Yeah.
Today's rising rates are a little different. What we're actually seeing is an increase on the long-term rates, meaning that the curve is actually steepening. Bond prices are starting to price in things like future economic growth, inflation, as you mentioned. And so whether you agree with that or not, that's what the bond prices and rates are saying. And so contrary to what we're reading, and if we look at some data, and this came out from a famous personal finance investment blogger, Ben Carlson, where he looked at what have rates what has the stock market done when rates have risen. And so we have a chart here that we put together based upon Ben's data, and you can look through these periods, different periods here. From 54 to 60, interest rates are up about 2.5%. Total stock market return over that period, 207%. 03 to 07, rates up about 1.8%. Stock market finish, total return 83%. Most recently, 2012 to 2018, rates are up about 1.5%.
Right.
Total stock market returns during that time, 131%. So, could rising rates lead to a stock market crash? I mean, it's possible. Do we know what level of rates will do that? I don't think we necessarily know exactly if it will do it at all. So it's a tricky environment that we're in because we've never really been in such a low rate environment for so long. It's unnormal. It's by historical standards, we've like the average, when we talk about average, I think it's somewhere between 5 to 7%.
Right.
The long-term average of interest rates, and we're at zero in certain places, right? It's negative territory in certain countries. So
yeah.
But the point is, rising rates don't always spell doom and gloom for stocks.
Yeah, I was just gonna say, I think that I'm a big believer that often like either all or most recessions are caused by bad policy decisions more than anything else. And I think the bigger risk out there is not necessarily higher rates, but the increase, the velocity of increase. Mm-hmm. And so if it happens faster than what's expected, like, the Bank of Canada's come out and said they're going to wait 2 years before increasing rates. My question is, what if you're wrong? What if you're wrong? What if inflation kicks in faster than you expect it to be and you're forced to increase rates?
Yeah.
And if it happens faster than what's expected, then that might throw people off. I mean, at least on a short-term basis.
Well, as you were talking there, I couldn't help but think, but what about the risk of not like you said, not kind of incrementally keeping ahead of what's going on and rising rates at a healthy rate? Are we, creating, by keeping them so low for so long, what kind of problems are we creating there? And I don't think anyone truly has the answer, which then means when it comes to portfolio management and planning the investments, you're having to kind of balance a lot of risks out there to protect yourself. And I know that's been a big theme of our portfolios here for the last little while. We're not predicting inflation because we can't predict that with any certainty. There's so many variables. They've been trying to get it for however long. They keep falling short. But we go, what if? What does that do to our clients? So put the proper pieces in the portfolio there that we believe could weather the storm if inflation had to rise, rates had to spike, and whatnot. So
totally.
Been hearing this one a lot. I mean, we've been hearing it the past year or two here. SPACs. Everyone keeps talking SPACs. SPACs are everywhere. For those who...
Man, it's like 2021 is like the year of the buzzword. Like if 2020 was about the pandemic, 2021 I feel is like the year of like the buzzword in investing. Like, so like SPACs is like the latest, latest greatest.
What is a SPAC?
Well, so SPACs have actually been around for decades. Like this isn't actually a new thing, but they become super popular in the last couple of years. Like, I think the number was 2016. There was something like $3.2 billion in IPOs into SPACs. And then last year was like it might have been over 25 to 40, somewhere in there.
Like an enormous,
huge increase in it, and it's just become that much more popular, and especially with like celebrity investors, right? Yeah. So what it is, it's a special purpose acquisition company. That's what SPAC stands for. And really, I think it's actually a really interesting structure because the whole idea was, you're going to create a company that you're going to do an IPO with this, with the idea that it's not actually an operating business. Like most of the time when we're talking IPOs, it's an operating business that is doing an initial public offering, and you're buying into that operating business. A SPAC is doing an IPO, getting money in so that they can go and acquire other businesses. And they were originally created because you'd get somebody or a group of people that had like a specific specialty. And again, that's where the special purpose part of it comes in. But you had a specialty in, let's say, I don't know, manufacturing or aerospace or something like that. And what they would do is do the SPAC so that they could go and buy up one of these, either one or a few or many of these companies in that space. But they had like a specific specialty in that. Not all that different than like kind of like a specialty ETF. I mean, different structure obviously, but kind of the same idea. So anyway, that was the whole framework of it. And then what's happened in the last little while is that they become really popular because of guys like, well, Richard Branson, for example, they started the VGAC.
Bill Ackman,
Chamath got into, started one.
Everyone's doing SPACs.
So you get celebrity CEOs, celebrity investors, philanthropists doing this, and yeah, it gets headlines. And what's it doing? It's collecting all this money from the retail public so that they can go and buy things like, 23andMe, Virgin Galactic, So what's interesting about it is it actually creates a really simple path for certain companies to IPO or to get onto the public market.
A lot more cost effective. You're removing a lot of the investment banking fees associated with taking a company public.
Exactly, because that's exactly what happened. Like Virgin Galactic is a prime example from last year or the year before. They got bought up by a SPAC. And essentially, the SPAC was already publicly traded. Mm-hmm. So that's how Virgin Galactic eventually became a publicly traded company, was through a SPAC. Mm-hmm. And it's happened with, 23andMe is the one right now with Virgin. And again, so it's a really unique process if you want to take your company to being a publicly traded company and get a bunch of money into it. It's a much more cost-effective, much more simple process because you're not doing all the filings for an IPO. You're not doing all the stuff that you need to do when you IPO a company. So anyway, it's an interesting structure. Are they blown up right now? 100%. Like there's a lot of momentum behind it because of the celebrity behind a lot of these.
Well, and as we were talking about interest rates, there's a lot of money right now out there looking for places to go, and so combine that with the celebrities and the SPACs and the buzzwords. It's. I don't think it's a surprise the behavior that we're seeing.
No, so I'm not saying don't buy into a SPAC because I think that they are an interesting structure, and if you want to get access to like companies that were formerly like private equity companies, you can get into access to them and invest in them. So that's a really unique structure, but I think don't go in it for the quick win because as we've seen with many of them, they take it on the chin potentially early on, and they can be quite volatile. And it's just because of the nature of the companies that they're often buying. But yeah, you got to be very careful about them in the early days. If you're a long-term investor, though, if you're like really buying into, let's say it's 23andMe, mm-hmm. like I believe in this business because of what they do and what they stand for and the management behind it, then you're a long-term investor. You're looking at least 5 years, but 10 years and maybe mm-hmm. longer out. And then it could be a really unique way to get in early on, basically.
Well, even back to what we were talking about with Ray Dalio and where he's seeing the bubbles, when we look at a lot of the SPACs being created, there's a lot of these emerging technology companies that are involved with these SPACs. So,
I guess like the thing would be is like make sure you understand what you're buying into because you're buying into like there's a reason why they're doing it through a SPAC. Like sometimes it's like, well, I know, everybody knows I'm a huge Branson fan, but like there's a reason why he did it in a SPAC form because he wanted to get a lot of other people's money so they can go and do these things, right? So it's really, you got to buy into what that vision is and mm-hmm. be on board with it, and because you're essentially riding along with the Bransons or Chamath or whoever, right? So mm-hmm. Anyway, unique structure, super buzzy right now, as are a lot of things like Bitcoin, you name it. Like there's a lot of buzzwords out there right now, but unique structure and could be quite valuable. Okay, I got one more question for you because we've been talking a lot about like real estate and stuff like that, but I want to talk about industrial warehousing.
Yeah,
what is industrial warehousing?
Well,
or what's happening in industrial warehousing?
Well, yeah, industrial warehousing or industrial warehouses where goods would be held and distributed and are important kind of pieces to the supply chain. Canada right now is on the verge of a warehouse building boom. This is according to global commercial real estate company CBRE. Nearly 40 million square feet of additional warehouse space is going to be needed in the next 5 years. And to put this into perspective, that's more than all the leasable warehouse space of the country's 3 largest industrial markets, which I believe are like Vancouver, Toronto, and possibly Montreal. So there will be little choice, but new facilities are going to need to be built. What's causing the boom? Well, we have another chart here. This is probably going to be not a surprise. You maybe just haven't really thought about it, how these are interconnected here. But in this chart, comes from Bloomberg, and we're looking at the amount that Canadians are spending online, e-commerce. Again, so e-commerce sales rose 32% last year. in Canada, a trend that's likely to continue post-pandemic. Well, it feels like, when is there a post-pandemic at this time right now? So I don't think this trend is slowing down anytime soon. Here in Canada, we've actually lagged behind a lot of other developed nations when it comes to e-commerce here. But Canada is now posting some of the fastest growth of shoppers online, and our shoppers nearly doubled their share of online purchases, up to nearly 40% now during the pandemic. So 40% of all kind of retail purchases going online. So that's really what we're seeing here, is there's a huge demand and huge need for warehousing when you're moving. We're no longer, we're still going to a lot of these places, the Walmarts of the world, the physical retailers, but with things online, like when you buy something, you're still buying a thing. It needs to be somewhere, it needs to get somewhere. And
Sure.
So with this rise in e-commerce and less physical retail, the demand for the warehouses has really spiked. And so it's been, I know we've spoken to some real estate professionals here on a live stream. We have a lot of contacts in the industry.
Yeah.
Industrial's been a bright spot in the real estate market pre-pandemic, and it's probably accelerated during the pandemic. It's likely to continue to be a bright spot. I was speaking to one of our close friends this morning about it, and again, he thinks there's a lot of runway there in the industrial space. And then again, just outside of it, multifamily, like less about the warehousing, but those are really the two bright spots in commercial real estate.
Yeah, I find it so interesting because like the pandemic brought to light, everybody was just like, oh, real estate's going to be dead.
Yeah.
Real estate's dead. And all they were thinking about was like, we're at Portage in Maine right now, 201 Portage is the tower. That's all they were thinking about.
Retail.
But just like anything, there's multiple facets of real estate. And again, don't just buy a blanket, but if you're choosy about these things, there are opportunities, and that's exactly what we're pointing out. Like the pandemic has created opportunities, and where we've realized where our weaknesses have been, and one of them is industrial warehousing for the future. And you're right, it just accelerated the trend more than anything. Like, we were probably heading this way anyway.
Even if we're talking industrial, we just saw Joe Biden sign an executive order around the production when it comes to the manufacturing for things like semiconductors, pharmaceuticals. Again, these are all things. These are things that need places, real estate, to operate. It's not just, I think we've become overly obsessed with that tech and software eating the world, but have failed to think that with these tools that are doing really good and being able to utilize these tools, behind that, there's still a physical economy where things are moving around.
Well, and even a national security issue. I think we realized that during the pandemic when we were relying on all these other countries to provide us with things like PPE and you name it, right? The vaccine, where it's being manufactured, right? You're relying on other countries to have your best interest at heart, which maybe not the greatest idea. So we've learned that we need to bring some of this stuff back home,
Yeah.
Again, if you're choosy, I think there's opportunities out there, and as the experts that we've talked to have pointed out, they're seeing booms in certain areas, but maybe not necessarily in downtown office space.
Yeah,
just
not
other
your traditional strip mall.
Yeah,
piece of real estate. So
right.
With that, I guess we can close things off today. Thank you again for everyone tuning into the Endeavour Exchange. It's always a pleasure to be on here speaking with you, Grant. Check us out, www.endeavourwealth.ca. All of our advisors here at Endeavour Wealth's contact information is there. If you have any questions, you want to take a look at your portfolio, your financial plan. Planning is really big right now. There's lots of changes going on, and especially with the clients that we work with.
Now more than ever.
Yeah, the business owners, the incorporated professionals that we deal with, the incorporated medical professionals, all those people. There's a lot of changes going on right now, and planning, I don't think, has ever been more important to that. So if there's any questions, feel free to reach out to us. You can check us out on YouTube as well, Facebook, LinkedIn. So we're here and we're ready to answer questions.